Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
It's Musk's moment of truth. Tesla kicks earnings season into high gear after the market close. More bad news for Apple. iPhone sales in China fell 19% during the March quarter, the worst performance since 2020. And the FTC sues to stop Tapestry's $8.5 billion takeover of Capri, alleging the deal will harm the luxury goods market.
Are you ready for the busiest day of this week? Nearly $17 trillion worth of equity will report. The stock market just clinging by its fingernails. We've done the Bloomberg poll on MLive. Two-thirds of the respondents, of over 400 respondents, say the earnings will give us a nice kicker. Goldman Sachs, they've been doing the hedge fund analysis. The hedge funds have been the biggest notional buyer of equities in more than a year. As the rest of you were selling, the hedge funds were getting in there and bidding up. Are you ready for your two-year auction today? $69 billion worth of twos will come to the street today. It's not expected to see any indigestion. I love what Bob Michael had to say yesterday, which was he's hanging on with his fingers and his toes in terms of his long bond positions, but he wants to see a little bit more inflation print before you add duration. Euro is bid this morning up an eighth of 1%. The French PMIs show a little bit of price pressure, and German manufacturing back in the expansion territory. Keep an eye on Apple. Danny, we've just had a little bit more data in terms of the shipments in China. They are down, or the sales in China down 19%. The stock is down 0.5%. Good morning earnings.
This is one of those things that if you told me the news before, I would have assumed Apple would have been down a lot more. But Manus, perhaps it's because this is nothing new. We learned from IDC not that long ago that their overall shipments had fallen by 10% in the first quarter. But this is the bad news. So many people had pinned this earnings season on the growth and the revival of tech. That'd be the thing that would save this equity market. Already we have a blow to Apple.
If you strip out NVIDIA, you're left with a very different complexion in terms of the technology earnings. It is NVIDIA that will skew the earnings. By the way, on Apple, what poor timing for Bank of America. What tragic timing for Bank of America. But they're there, which is it's still their top pick. They talk about the cash flow. And don't forget, this is a stock that does dividend and buybacks, and it's got a gusher of money on its balance sheet.
They're among those that stand alone on the sell side. Both Morgan Stanley and our Bloomberg intelligence analysts say China is the reason that Apple cannot be as strong as it once was. But, man, as I said, it's a big week for earnings, a big week for tech earnings. More than 40% of the S&P's market cap is going to be reporting. We're going to have a spotlight on the Magnificent Seven. Joining us now is Kevin Mahn, President and CEO of Hennion and Walsh Asset Management. Kevin, I loved during the break when we were talking about Apple, you're like, maybe we're down to Mag 5 now. I mean, how much shine is being taken out of these stocks like Apple, Tesla, especially as we're about to hear their numbers?
The Mag 7 is very important to the psyche of the investor because most individual investors hold one of those 7 positions, as do fund companies. And I think to this earnings season, how important it really is. According to FactSet, the information technology sector is expected to grow their earnings by 20% year over year, communication services by 20% year over year, but the rest of the S&P 500 by just 0.5%. Tech earnings are incredibly important to the psyche of the market and where we go from here. Of course, we have to talk about the Fed, too, because they're pretty important.
Yeah, I mean, there's the macro, but since we started on AI, you're both going to have to help me now with the sport analogies.
Yes.
I don't know whether you're on cricket or baseball.
Baseball.
She can
he's a cricket guy.
I'm not a cricket guy.
So as far as AI is concerned, we are in the artificial. So what inning are we in within the artificial intelligence AI game? This is what you had to say. I would suggest that we are just in the batting practice and that AI, before the AI double header. So what exactly is, if we're in batting practice, what is the double header?
Yeah, there's so much more runway ahead for what artificial intelligence can actually accomplish in our society. Last quarter, we learned that 36% of all S&P 500 companies actually use the terminology artificial intelligence or AI in their quarterly earnings reports, the most on record. We've learned that Blackstone and Digital Realty have announced a $7 billion joint venture to build data centers all across the world in cities such as Paris, Frankfurt, and even the northern parts of Virginia. We heard Microsoft announce that they're building over $2 billion worth of data centers in Japan by the end of 2025. Artificial intelligence isn't just some hot new fad. It truly is transformative, and there's going to be more and more investment dollars chasing that elusive technology.
But maybe Tesla is a lesson not necessarily in AI, but you can promise all the growth you want, all the spending you want, And if you don't come through with profits,
That's right.
it's not going to benefit you. So in this earnings season, if we are just at batting practice, how much can you really trade on it? Do you need to see the actual fruition of some of these AI projects before you say those valuations are worth it?
You can't wait too long. NVIDIA is an excellent example of that. Unfortunately, NVIDIA doesn't report till May, but I do think that will be the tide that lifts all the other ships as well once we get to May. Tesla can't seem to get out of their own way, right? They've cut jobs, they've cut prices, they've abandoned the production of their lower cost vehicle. And now we've learned, at least last quarter, that global deliveries fell for the first time in 4 years. Their stock doesn't meet our selection criteria. Let's take them out of the Mag 7 altogether. I still think Apple has a lot of promise going forward, but Microsoft, NVIDIA, those are some pretty strong names, and they're going to compete and probably be two of the winners in the overall AI race.
I like your punchy approach. Just get them out. Chuck them out of that, Mike.
See you later.
You talk about your analogy. I was just listening to Jeff Kerry there just before we came to air, and he's talking about the commodity evolution co-joined with AI. But when you look at AI, you talk about the brain, the heart, the limbs, and the nervous system. Do you equally allocate across the functional body, or where do you ski? I mean, I hope you give a little bit more to the heart.
So to kind of expand upon that, the brain, that's the software, the algorithms, and the models that AI uses, right?
Yeah.
Then you have the chips and the semiconductor. Everyone talks about NVIDIA, but how about Taiwan Semiconductor? 60% of the global market share and the world's largest chip foundry, and they also just got a grant from the Chips and Science Act because of their Arizona subsidiary. Then you look at the hardware. Companies like Vertiv. Who's ever heard of Vertiv? They're industrial companies, but you know what they do? They provide the power, the infrastructure, and the cooling solutions to the all-important data centers. And the data centers are really the nervous system that make all of this work. Companies such as Equinox, Iron Mountain, and of course, Digital Realty. And guess what? All those data centers come from the REIT asset class. REITs actually pay pretty attractive dividend yields, and Digital Realty has a 3.4% dividend yield. So you get to play in the AI ecosystem, but you also get some income too.
Kevin, as you said, it's not just the earnings, it's not just tech, it's also what the Fed does.
Yeah.
And here there does seem to be a divide as to whether or not the correction, I mean, we're only down like 3% the past 6 days. It feels like a correction given how calm it's been, but whether or not it will endure. On one side, you have Marko Kolanovic, who basically says it will endure because you have the issue of higher yields, you have the issues of higher commodities.
Complacency.
Exactly. And then on the other side of that, you have Citi, who say earnings are going to save us. Which side are you on?
I'm in the camp that the Fed hasn't changed since we started this year, other than raising their inflation forecast. They actually raised their inflation forecast for the end of this year, core PCE, to 2.6%. And they don't believe inflation comes back to their 2% target until the end of 2026. Yet they're still forecasting, as of March 20th, 3 rate cuts this year, 3 rate cuts next year, and another 3 rate cuts in 2026. That tells me that the Federal Reserve is more concerned with this economic slowdown potentially dipping into a recession than they are with inflation staying above 2%. Will they go through with those 3 interest rate cuts? I don't know, but there's still a path forward. The way I see it, they don't cut in April, they don't cut in June. Perhaps they cut for the first time by 25 basis points at the end of July. They don't meet in August. Their last meeting before the presidential election is in September. They don't want to appear too political. They pause in September. They don't meet in October, and then their next meeting is 2 days after the presidential election. One more cut there, and perhaps one more cut in December, and they get to their 3 interest rate cuts. Again, I'm not suggesting that's going to be the path forward, but there is still a path forward.
Well, as you say, this market still has a set of rose-tinted glasses on it.
Very much
a little bit hope rather than delivery. Great to have you with us this morning. That is Kevin Mahn of Hennion Walsh Asset Management, our guest on the markets. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. Euro area private sector activity advanced to the highest level in almost a year, driven by a buoyant services sector and Germany's return to growth. The April composite PMI index increased to 51.4 in April, stronger than the 50.7 predicted by the economists, and above the 50. The important 50 level, that indicating the difference between expansion and contraction for a second month.
U.S. campus demonstrations are spreading as the Passover holiday begins. Columbia University moved its classes online after days of protests roiled its New York City campus. Pro-Palestinian demonstrators want the school to exit all investments that benefit Israel's government.
The Wall Street Journal reports the U.S. is drafting sanctions that threaten to cut Chinese banks off from the global financial system. It's part of the efforts to stop Beijing's commercial support of Russia's military production. Secretary of State Antony Blinken is heading to Beijing today, Tuesday.
Coming up, the U.S. FTC attempts to block a merger between owners of the fashion brands Coach and Versace. We're going to have more on that still ahead.
And the EV maker is consumed by chaos. Tesla gets ready to report its results after the bell. Context matters on Bloomberg.
This is the period for Musk. Lay it out. Don't just talk, walk the walk. Because the benefit of the doubt's not there. Yeah. And this has gone from a Cinderella story to essentially Friday the 13th.
Dan Ives saying it like it is at Wedbush there, the analyst on Tesla. That was last week on Bloomberg Brief. So we're kicking off with the earnings today for Tesla after the market closes. Joining us now is Oliver Crook. Crook, good morning to you. I mean, we've just had a guest on the show who said Tesla just cannot get out of its own way. There's many threads to follow in this story. What do you think will be the most pivotal for the market to focus on? Good morning.
Yeah, good morning, Manus. I mean, listen, you have to deal with the numbers first as a sort of the anchor to begin the conversation. And we know that in the first quarter, they had the first sales decrease since the pandemic in 4 years. We're likely to see revenue drop for the first time in as long this quarter. We're also expecting sort of the sort of profit outlook, operating profit to drop as much as 40%. And yes, we're going to care about the outlook and all that sort of thing. But as you know, the guests have been saying, it's really a question of what is the story of Tesla right now? The answer to that earlier this year was we're going to build a cheaper car. We're going to actually take a look at the manufacturing process. We're going to do something very different to get that cheaper car to market, and that is how we're going to win. Then we understand Elon Musk basically shelved that idea and say, no, we're actually going to go, quote unquote, balls to the wall on autonomous driving. And that is what he put forward for these robo-taxis. And that is a sort of a Muskian way of doing things, right? There's a lot of competition for cheaper EVs. A fully autonomous robo-taxi would be something entirely different as the sort of initial Tesla car was. But again, that is very speculative at the moment. So what we're all looking forward to is, yes, the earnings out after market today, but really that earnings call where Elon Musk will have to lay out and sort of get a bit of silence and control to try to tell the story going forward for Tesla.
Oliver, some people could argue this isn't just a Tesla story. It's not just chaos at Tesla. The reason that they're having to cut these prices, the reason they're having this issue is that EV demand in general has been struggling. People don't want to pay up for EVs. I know the IEA had an outlook for the sector, for electric vehicles. What does it say, whether this is a Tesla problem or an EV problem?
Yeah, Danny, there's certainly elements of truth to that. But overall, in aggregate, in the first quarter, they said that EV sales across the world rose by 25%. They expect, 1 in 5 cars to be sold this year to be EVs. So that is still a growth story overall. What is interesting is that it is a China story. Almost half of the EVs, 45% that will be sold this year in China, are going to be, of all the cars, are going to be EVs. And that is because they're just a lot cheaper in China. Overall, again, they look at the numbers, 60% is overall EVs are cheaper than they are of combustion engine cars in China. That is very, very rare. You don't have that in Europe. You do not have that in the United States. And what it means is that last year, China became the biggest exporter of autos, overtaking Japan, overtaking Germany. And so all of this is coming to the fore. But yes, it is a China story. And that is what all of these car makers are really competing against, that price point where China is just basically a full head ahead.
Yeah, also in terms of quality delivery in the EV space in your backyard, if you get into a German EV relative to a Tesla EV, the difference in quality is manifest. Let's talk about some of the Americans. GM is going to report their numbers. Now, look, it's not just, let's be fair, it's not just Tesla that's got problems in China. GM's also under a bit of pressure there as well.
Entirely. It's their second biggest market, and there actually have been years where in GM they outsold the United States in terms of China being that significant a market. I mean, last year about a third of their sales came from China, but they've really been losing a lot of ground there, right? And that is in part, just that EV story, and that China has really dumped so much resource into their domestic market and really funneling the consumers towards that. So we're expecting to watch, yes, the Chinese market very closely, but pricing is going to be key, right? We had a sort of record for pricing last year. That is certainly coming down. The question is, how soft is it? And in terms of the outlook, I mean, the German car executives I've spoken to throughout this year, they're very reticent in terms of giving clarity on what the back end of the year looks like. Yes, that is a rate story, but it's a very cyclical sector, so it's hard to know exactly what's coming. I mean, we're going to get the earnings out at about 6:30 a.m. New York, and the earnings call at about 8:30. So we'll be watching those points very closely.
Oliver, appreciate it. We'll be watching with you. Bloomberg's Oliver Crook there. Now to other earnings. Novartis raised its forecast as sales of blockbuster medicines for heart disease and psoriasis outpaced expectations. It's giving the stock its biggest boost in 9 months, up more than 7 1/3%. Bloomberg's Anna Edwards spoke with the CEO earlier today.
We're broadly more positive about the momentum we're seeing in the business. One, we saw very good performance across our growth drivers, both established medicines like Entresto and Cosentyx, but very strong growth from our recent launches, Kesimpta, Kisqali, Pluvicto, Leqvio. So when you have that broad base of medicines all growing really well, that gives us confidence for this year, but also for the years to come. In addition, we saw our performance broad-based from a geographical perspective. Very strong performance, U.S., ex-U.S., Europe, China, Japan, also giving us a lot of confidence. So while there was a small contribution from generics getting pushed out, we're reiterating our confidence in our 5% plus sales growth guidance out to 2028 and our 40% plus margin guidance out to 2027, along with the various guidance raises you just mentioned.
Can I ask you about Pluvicto then, Vas? There's clearly one of the drugs, a cancer drug that you have high hopes for. It does seem as if sales came in perhaps just a little shy of expectations, but I wonder if this reflects a broader concern about convincing the market to pivot towards a new type of a targeted radioactive therapy. Are you concerned about how long it's taking to convince the market that this is the way forward, or do you not have concerns there?
No concerns. We feel very confident about the Pluvicto outlook. We saw strong quarter-over-quarter growth, and it's important to note we're just now coming out of a supply disruption we had last year. Now in the first quarter, we had 99.5% on-time delivery of the medicine. We're seeing a broadened base of growth in the United States from treating centers that are getting comfortable with this new technology. It is a very novel approach, and so oncologists need to understand they can refer patients for this therapy, radioligand therapy, for prostate cancer patients. The other opportunity we have in the second half of this year is this medicine will go global. We'll have the opportunity to take Pluvicto outside of the U.S. at scale, and that will give us further growth. The most exciting part of the Pluvicto story and our radioligand therapy story in general is moving into new cancers and new cancer settings. So with Pluvicto, we confirmed earlier this year that we will file for the PSMA-4 setting for Pluvicto. That will allow us to broaden the indication base. And we've also done a number of deals and have in-house programs to bring more radioligand therapy forward, therapies forward. So we think this will be a significant market opportunity for the company.
That was the Novartis CEO there, Vas Narasimhan, catching up with Anna Edwards earlier on. I mean, it seems as if that company has been on a transition, a metamorphosis year after year. I met that CEO on his first interview many years ago, and he is perhaps one of the most convincing CEOs that you will ever meet, completely committed to the change program.
He is, and this is what I would say. It's great to see a pharma company do well, not just based off of weight loss drugs.
There you go, bringing it home. The stock is up. And whoever christened the phrase bolt-on M&A, well done. The CFO says they're still in the market for bolt-on M&A. Quick snapshot of markets, 20 past 5. We're counting down to Tesla. We're all excited about that. It's the busiest earnings day on the street so far this quarter. SPOOs are up 0.1%.
It's Bloomberg Brief. Danny Berger and Manus Cranny in New York. Manus.
Yeah, let's get into the front pages. This is what we're taking a look at. Headlines around the world. First up, Donald Trump's first criminal trial. It began on Monday, Danny. Prosecutors and the defense team making the cases on the former president's hush money payment to the porn star Stormy Daniels. Court proceedings are scheduled to continue later today.
Next up, Manis, the U.S. Supreme Court signaled sympathy for cities struggling with homelessness. This coming from the Wall Street Journal. The court's conservative majority suggested Monday that their current approach intrudes on the discretion local officials need to address the issue. A decision is expected before July.
And investors have slashed the size of their, guess what, risk parity funds. She's written about it for years, by over 70 billion. This was from their peak 3 years ago. And who is the one that's perhaps taking the biggest sting, Danny? It's Ray Dalio.
Right. Well, the man essentially invented risk parity. They don't call it risk parity, they call it all weather. But quants have looked at it from that and said, this is what it is.
It's easier to market all weather, isn't it?
Yeah, it's a little, risk parity doesn't have the same thing. But what it does is it essentially overweights and it's over-leveraged bonds. So the thing worked really well post-GFC because bonds did really well. But what happens when the bond bull market is no longer with us? Can this strategy survive? That had been the criticism for a long time. And now that it's happened, now that the bond market has turned, people are saying, see, look, this was just an over-leveraged bond portfolio.
Yeah, but I mean, this is the third year in which bonds have simply just not delivered. It was supposed to be the year of the bond. But of course, the stiff competition for the theoretical risk parity is, of course, the other favorite theme of this show, which is private credit. And in terms of diverting your money, if you're not getting your return on your equity within the risk parity funds, you probably see something a little bit more tantalizing with private credit. But it's all about Tesla.
I was just thinking, am I a bandwagon reporter? I did risk parity and then private
No, I
credit.
would never accuse you of
Just
being a
doing all the hot
bandwagon
things.
reporter. You're zeitgeist reporter. That's what you are, not bandwagon.
I'll take it. Okay, Tesla coming up. From our global headquarters in New York, I'm Danny Berger with Manish Cranny. Let's set your agenda.
Musk's moment of truth. Tesla kicks off the earnings season to high gear today after the market closes. More bad news for Apple. iPhone sales in China fall 19% during the March quarter. That is the worst performance since 2020. And the FTC sues to stop Tapestry's $8.5 billion deal to take over Capri, alleging the deal would harm the luxury goods market. Handbags would become more expensive. Crisis. Danny.
Because they're not already expensive. They're so affordable now. But man, there's no let up in the calendar today. Yes, we might not be hearing from Fed officials ahead of their meeting next week, but it is a busy earnings season, the most busy week on the calendar. We got Tesla on deck today. S&P cracks the 6 day of losses, gains yesterday, potentially on some algo buying. We're up higher again today, 0.2%. You also get a let up in the bond market, too, backing off of 5% on the front end. We're going to get $69 billion of 2-year yields on auction today. Again, around 5% yield, perhaps there will still be healthy demand for it. At the same time, gold. Okay, this thing has been falling a significant amount. It falls a further 1.33% this morning. It had been up 16% year to date. It fell significantly yesterday as well. Some folks, there's some chatter out there saying perhaps it's margin calling with the amount that Nvidia fell. Maybe that trickles over to gold because of a lot of retail people hold it. But there's an overriding question of, is this the end of gold's run or is this a healthy correction? In terms of a healthy correction, man, is the thing I love. Marco Kolanovich says the U.S. equity correction will continue. There's too many stressors out there for it not to in terms of macro land. Can we call this thing a correction? I think we're down some 3% in the past 6 days. I'm not sure that's a correction.
No, you can't. I mean, you know, when it was down 5.5% in 6 days, you could say we were nervous, but we seem to have re-galvanized ourselves for this earnings season. You're going to have to wait a month for Nvidia to deliver the numbers for them. In the meantime, we're going to deal with a little bit of volatility from Tesla, from Microsoft, etc. I found interesting Goldman Sachs. They look at what the hedge funds have been doing. And in the 3 weeks that you've all been out there selling and getting incredibly nervous, guess what the hedge funds have been doing? They've been buying. They have been buying the largest notional value in over a year. Of course, they are fast money, and so therefore that leads to some of the movements. But it just shows you what is going on under the hood. And Kolanovich says that this level of complacency will not be, you will pay for that complacency.
Well, the irony of hedge funds buying a lot now is some people were saying with the past 6-day sell-off, you finally get this washout in positioning. Finally, it's safe to jump back in. And of course, it's this very circular argument because it's safe to jump back in. The hedge funds go back in. And hey, maybe this market is a little bit overbought again.
Well, we'll decide whether it's retail on the wrong side or hedge funds. That can be the debate, but it is going to be all about the uncertainty and the uncertainty around the iPhone. We've just covered that. The sales in China fell 19% during the March quarter, making it the worst performance since 2020. Joining both of us on set this morning is Mandeep Singh, Bloomberg Intelligence. Look, we knew things were bad for them in China, but, things are tough for everybody in China in a myriad of different product areas, from autos to GM to Tesla and Apple. But what is the root cause of the problem? Is it pricing? Is it government policy? What is it that has caused them so much angst in China this quarter? Good morning.
Yes, good morning, Manus. And look, I think with Apple, everyone knew that China would be bad, but I think investors are grappling with is it's not going to get better anytime soon. And in this case, Huawei coming up with a phone that's comparable to an iPhone in such a short time just puts into focus how much of stickiness Apple has in the region. And look, the government policy is playing a role over here. But in the end, Apple's revenue growth is driven by iPhone and market share gains. And that's not going to happen given China is a 20% region. And they're losing market share over there.
I mean, the irony is, Manus, you and I talked about this, is literally yesterday, Bank of America puts out their top picks, and Apple is one of it. Not that this would necessarily change it, because as you said, Mandeep, we knew that China was weak. If it is all based on the iPhone now, and Apple keeps looking for its next big thing, it's clearly not cars anymore. They've given that up. They're plowing money into robotics, into AI. Is it clear that there is a next big thing?
Even if there is one, and I bet you, they will come up with a device category that's good enough to, add to their iPhone install base. But China being such a big market for them, I mean, it makes you wonder, has Apple reached peak earnings, at least for the next 2 years? And the answer probably is yes, because how do you make for that revenue shortfall? Either you have to make people buy more phones. You and I own one iPhone, probably we should be owning two, or they raise prices. That's the only way they keep growing revenue to make up for that shortfall in China, and that's a bare case.
I've given enough of my life to my various phones and various technology devices. With that concept that this may be peak iPhone demand, how quickly can and will India supplant the 20% of revenue that China delivers at the moment? Blow the myth apart.
Well, so look, I'm in the camp that Apple will continue to gain some share from, Samsung or for others in regions outside China. But Apple not only has a revenue problem, they also have a supply chain problem in China. Most of their manufacturing is still done in China in terms of the assembly, and they have to relocate the supply chain. That's where India can be helpful in terms of relocating. But in terms of making up for that lost share, I think it will be very hard, especially if we are modeling the revenue would go to zero in China over the next 2 years. How do you make up for that revenue shortfall?
Now, in terms of, company spending on AI, I know Meta also, their whole thing is also perhaps catching up with TikTok, having a video platform that can have the same amount of AI. We've been debating a lot about this because TikTok's obviously up for sale, and we want to know, is the algo going to go on sale? So whether or not that's included in the next version of TikTok. Is Meta all caught up in TikTok's algorithm yet? Have they made the progress enough?
They have. And look, I think when you look at the numbers, 200 billion views for Reels every day. Contrast that with YouTube Shorts at 70 billion, and TikTok is around that same vicinity. It just goes to show that Meta has the family of apps to showcase their short-form video product, and they've done that successfully. It's in the numbers. So clearly, Meta not being exposed to China is a good thing. They don't make any revenue there. And the fact that they have caught up with TikTok from a product perspective really helps them kind of navigate this environment much better.
It's an amazingly interesting, differential, isn't it? Not exposed to China, not dependent on revenue for China. Therefore, the differentiator, the divergence will only ever grow. But you talk about how they use the AI capacity in terms of driving the advertising narrative, and it's so much sharper. It was always sharp, Facebook and Instagram, but it's even more defined with the AI iteration.
Yeah, and look, Meta has their own large language model. I mean, there are only 3 companies among the hyperscalers that have their own large language model when it comes to generative AI. Meta has actually open sourced their Llama model, and they're trying to build a community. So clearly a lot is going right for them in terms of having that infrastructure, the GPU allocation from NVIDIA, and then using it to build their own large language model. We don't know if Amazon has one yet of their own large language model. We definitely know Apple doesn't have their own large language model. So they are in that race where they have caught up with Google and Microsoft OpenAI, and they're right up there when it comes to generative AI.
Mandeep, that all sounds wonderful, but the issue with us, macro obsessives is that, every time we look at an ad giant like Meta, we think, well, surely they will be dependent on the health of corporate America, the health of the corporate world. And we have surveys showing, corporate confidence for small businesses at multi-year lows. Is that going to affect them this quarter and the willingness of companies to buy ads?
You're right. So Meta is exposed more so to small businesses than some of the other hyperscalers. So from that perspective, ad pricing probably will be muted when it comes to, the prior comps that we have seen. And look, there are only 2 companies where you want to spend your ad dollars still. It's Alphabet and Meta. And that hasn't changed. The smaller ones are struggling more, the likes of Snap and Pinterest when it comes to ad targeting and ad pricing. So in this case, yes, if the overall digital ad market is down, then it will affect Meta, but they're still the best exposed when it comes to the rebound that will happen at some time.
The debate in the quarterlies up until now has been, how splendid Meta is, how outstanding Microsoft is in their space, but perhaps the laggard is Alphabet, owner of Google. Now, what is going to drive that stock? Is it going to be the cloud, which is the traditional sort of thing that they lean on, likewise with Amazon? Or are they in the catch-up game and therefore their capex is going to outweigh any alpha in the cloud?
Yeah, so look, Alphabet is still a digital ad company. If the search segment doesn't do well, they're going to not do very well with their numbers in terms of where consensus is. So that reliance still remains, but what they've done well is YouTube. That actually should come out better than Netflix based on our estimates, simply because YouTube has got a nice traction in terms of converting their freemium users to subscriptions. And if the ad market is coming back, especially on that brand advertising side, I think YouTube should do very well. And then cloud, as you mentioned, they have a lot of the NVIDIA GPUs that they can rent out because they rely on their own chip for training large language models. So that should actually help their cloud revenue, but we have to see it in the numbers. Microsoft quantified that AI growth on their cloud business about 5%. We want to see that higher for Alphabet, given they have more GPU allocation that they can rent out.
Right. Well, we'll get both those numbers Thursday. Meta tomorrow. Mandeep, good luck for it. I hope you sleep well this week because it's a busy one for you. Mandeep Singh there of Bloomberg Intelligence. Okay, coming up, the FTC sues to block a merger between 2 fashion houses. We're going to have more on that next. Context Matters on Bloomberg. This is Bloomberg Brief. Danny Berger and Manish Cranny in New York. How about a little bit of affordable luxury? Well, it's going to stay small because the FTC has sued to stop fashion group Tapestry from acquiring its rival Capri for $8.5 billion. Bloomberg's Kimberly Adam joins us now for more. Kimberly, this really is, isn't it, the first time that regulators have stepped in to fashion, have stepped in to luxury. So what does it mean to have this deal blocked?
First of all, this isn't the first time Tapestry has done this, believe it or not. So Tapestry doing this, the FTC has ruled that they're going to block this deal. They filed complaints in the House and federal court in their house. This is going to raise prices for handbags, accessories, and luxury items. And it's also going to harm consumers, believe it or not. One other thing, it's going to harm the 33,000 employees that work for both of these companies because they compete intensely on everything from design, promotions, et cetera. So it's not necessarily a good thing. We have Tapestry. They're in charge of, or they own at least Coach, Kate Spade, Stuart Weitzman. Capri controls Michael Kors, Versace, and Jimmy Choo.
So what are the companies saying? I mean, the FTC, for the FTC to step into luxury good deal is really quite shocking. I was at home yesterday afternoon, and that's why I sent it through and said, let's spend a little bit of time on this. What is it that the FTC are accused of not understanding?
Well, they don't understand why this whole deal is happening right now. They believe that, especially when you go down to the quote from Henry Liu, he says this is going to further entrench the stronghold in the fashion industry for Tapestry. Henry Liu, he is the FTC's Bureau of Competition. He's in charge of that. That's what he said. This combined Capri thing would be the second largest personal luxury goods company in the U.S. behind LVMH. So,
but see, this is the thing. Okay, not to speak ill of these brands, but I look at them: Kate Spade, Stuart Weitzman. That's not exactly a stronghold in luxury goods. Again, if you compare it to someone like LVMH, who owns so much, I mean, is there not an element that this deal would help American luxury compete with European luxury?
We're talking about two companies, and we're talking about this merging of all these, just one huge brand, and it's Tapestry. They've done it before, so the FTC has had their eye on that. So here we go again, and they're trying to have this stronghold on the entire fashion industry. It's going to really make them strong, the second largest brand.
Okay, well, let's keep an eye on it. I mean, the issue is this, is that when you go into a store, and you look at the various brands, you go into various brands at various stores, most people don't actually know that it's one holding company that actually owns all of the brands.
Yes.
These guys have become like the streaming services. You don't know. They're all in bed together. It's like you turn on one channel and you don't know who owns what. It's the same thing now with these companies, right?
Yeah, and you find yourself buying all of them.
But this is a first.
All the platforms, all the handbags.
Shopping too much. Shopping too much luxury.
Never.
That's not bad.
Handbag wars at dawn on Bloomberg Brief.
It's not a bad thing.
Kimberly, thank you very much. Kimberly Adams tracking the deal blockers at the moment. Let's turn our attention over to the banks. Goldman Sachs is going through another bit of a shake-up. This time they're closing down an entire unit while expanding their team in Europe. Bloomberg's Charlie Wells joins us now. So this is about robo-investing. This was all part of the great dream of Solomon, which was going after the retail consumer, the retail customer, and a little bit of robo-investing. That is now moving along and out of the family, so to speak. Good morning, Charlie.
Good morning. Yes, Manus, that's exactly right. So, this represents a winding down of that consumer effort. Goldman has struck a deal with Betterment, which is a $45 billion digital investment advisory platform, and they're going to be moving Marcus Invest over to Betterment. And now this, as I said, represents a winding down of an attempt that they tried to bring the little guy into the firm. So with Marcus Invest, which took flight in 2021, the idea was that customers with as little as $1,000 could get some investment management advice. That is now going over to Betterment. But the more popular Marcus savings accounts that Goldman has had, that is a separate issue, and those are going to stay with Goldman for now. Goldman actually has $110 billion in deposits from there, and that is a rare success from this consumer foray, because that gives Goldman cheaper funding from unsecured borrowing that they needed. So this is a real boon for them. But that investment management service for the everyday person, that's going over to Betterment.
Yeah, I mean, I remember when they did this deal, when they partnered with Betterment, and everyone was, I mean, robo-investing was so hot then, maybe not so much anymore. And Charlie, elsewhere for Goldman, I mean, you'll know this story so well. The narrative goes, post-Brexit, everyone will flee London's financial services. Everybody will go to continental Europe. Instead, it's been more of a drip feed, but we're getting more drips from Goldman. What changes are they making?
Yeah, so this is maybe more of a bigger drip, I'd say. So their head, hard to describe a bigger drip, maybe a little bit of a drop, exactly. So Dirk Lievens, the head of financial institutions deal making in EMEA, is going to be moved from London to Paris, and we know that his team is going to double in size in the French capital. And Lievens, in an interview, said that there was a Brexit component to this, but this is also a part of the financial institution deal making acceleration that we're seeing over here in Europe. So we know here that a lot of banks, a lot of insurers, they've got extra cash from these higher rates, and they want to do something aside from buybacks. So what they're looking to do is to do some M&A, to do some deals. And actually, there's stuff to buy. I'm thinking about some banks like Societe Generale, which are going through some reorganizations. They want to sell some of those units, and they've got willing buyers. So this certainly has a Brexit component, as Lievens himself said, but it's also a part of that larger move of that deal-making acceleration on this side of the Atlantic.
We're also getting a little bit of news flow on UBS in terms of strategy on mainland China. This time, they're going to step back from building their own wholly owned mutual fund business. Why? Is there a big crossover with Credit Suisse? What is the rationale?
This is really interesting. And look, the mutual fund market in China is worth $3.73 trillion. So people want to get involved here. But what people familiar with the matter have been saying is that UBS is going to shelve plans to build a wholly owned mutual fund firm. If you look at other U.S. financial firms that have been trying to get into that mutual fund space in China, you see that this UBS move is more conservative. And the idea here is that it's just incredibly expensive and that the profit outlook is not positive going forward, so UBS will rely more on some of its local joint ventures. Now, I said this was a little bit more conservative. When you look at Morgan Stanley, when you look at JP Morgan, they have now taken whole control over those joint ventures. When you think about BlackRock or Fidelity, they built mutual fund firms from the ground up. So for UBS, this is a scaling back. And Manus, you mentioned Credit Suisse. Yes, this is more of a reliance on some of those joint ventures that both UBS and Credit Suisse had in mainland China.
Well, you talk about them pulling back because of the expensiveness of it being more conservative, but at the same time, Charlie, they're going to Silicon Valley, a place not known to be cheap for both real estate or talent or competition. It's going to open an office in the Menlo Park. It's going to open a Menlo Park office, rather. I mean, what do they do here? It's not like there's a lack of bankers in the area.
Huge amount of competition, and I think the word on the street is that, look, IPOs and deal making in Silicon Valley are going to come back. UBS, we know Sergio Armati has, the United States as a growth geography in his mind, and so we do know, according to a person familiar with the matter, that they have hired Sean Lynch from Barclays, who covered Tesla and covered Uber, and they're going to be trying to scale up and trying to bring in more of that talent. And look, UBS is a global firm, but we also know that one way that they could potentially differentiate themselves in a very crowded field in Silicon Valley, which also, I should say, is an incredibly global space, despite the fact that, we're talking about Sand Hill Road, which is where a lot of venture capital firms are. We have a lot of U.S. focus there, but they could potentially really sell that global presence that they've got.
And, maybe there's some ex-SVB bankers floating around who might be willing to get a job. Charlie, thank you so much. Charlie Wells there. Okay, coming up, it's a busy day. We're going to look at some of the earnings. Coming up, Context Matters on Bloomberg. It's Bloomberg Brief. I'm Danny Berger alongside Manish Cranny in New York. Let's get you set up for your trading day this Tuesday. General Motors, among many, will be reporting before the bell today. And then we're going to get some economic data, U.S. new home sales at 10 a.m. Eastern. And then after the bell, Tesla reports its first quarter results off the back of those shares selling off of, for many people, losing its Mag 7 status. And for, let's be honest, Manus, chaos at the company.
Yeah, it can't get out of its own way. That was our guest line this morning. Some other micro movers for you to keep an eye on. Danny, you just mentioned there, Tesla's up 0.6%. Let's see, mounting pressure there. Also, you've got General Motors. They've got pressure in China in terms of their sales there. They're going to report. And then you've got PepsiCo down 0.8% coming through with their earnings a little bit later on, just before the bell. So we're keeping an eye on all three of those. But undoubtedly, it is what we hear from Elon Musk in regards to the strategy for Tesla and the Model 2 versus the robotaxi. Danny.
It certainly is. Man, I also just want a quick check on gold this morning, falling significantly yet again, down more than 1%. Yesterday was its biggest drop in 2 years. Is it a mysterious seller, as Jeff Curry puts it? Is it more calm in the Middle East? Either way, selling off a lot.
Indeed. Keep an eye on crude. Jeff Curry still calling $100 oil. Go on the oil.